When I first got started in commercial real estate, sometimes I felt like I was listening to an entirely different language when sitting in meetings, and there's definitely some industry lingo that you're going to need to learn if you're just getting started in the business right now. And today, given the current state of the market, there are a few specific terms that are being thrown around a lot in today's environment that you won't necessarily find in a textbook, but you're going to want to know to keep up with the conversation. So to make sure that you are in the loop when these things come up in meetings, conversations with your manager, or even in an interview, in this video, I want to talk through 4 different commercial real estate terms and groups of terms that are particularly important in 2023 and what each of these are referring to in the context of today's commercial real estate market. So the first group of terms here is really a pack of 2 industry phrases that are essentially referring to almost the exact same thing, and these are the bid-ask spread and price discovery. The bid-ask spread is exactly what it sounds like, essentially describing the difference between what property owners are willing to sell their properties for in the market and what prospective buyers in the market are willing to pay for those same properties, given the current state of the economy, the cost of capital for investors, and future projected performance of the real estate sector as a whole. And when the bid-ask spread is being referred to as wide, this means that buyers and sellers are really far off from one another on what each believes valuations should be in the market, which generally leads to significant slowdowns in transaction activity overall, which is exactly what we've seen in commercial real estate over the last 12 months. And price discovery is directly related to this, but this refers to the actual time period in which a significant bid-ask spread exists and a general state in the market when buyers and sellers are struggling to find a midpoint where they can agree on valuations. Right now, many sellers are not willing to let properties go for a price point that's less than what they could have sold their properties for in late 2021 or even early 2022, but buyers today just can't justify paying these prices given the massive run-up in interest rates that we saw last year. And this is why in today's market, you'll hear a lot of investors and brokers talking about the market being in a state of price discovery or talking about how the bid-ask spread has widened significantly over the last 18 months to the point where many deals that would have traded in 2020 and 2021 just aren't transacting in today's market environment. Now, the next group of terms that I want to bring up in this video is directly related to cap rates, or the initial unlevered yield that investors expect to generate on commercial real estate deals, and these 2 terms are cap rate compression and cap rate expansion. Cap rate compression refers to decreases in market cap rates, essentially meaning that investors are willing to accept lower initial NOI yields, which leads to higher valuations in the market, and cap rate expansion refers to the opposite, an increase in market cap rates, meaning that investors are requiring higher going-in NOI yields, which leads to lower property valuations for very similar reasons. Most often, you'll hear these terms being used when investors are trying to determine or justify a projected sale value within an acquisition analysis, or just when describing how they believe pricing is going to change in the future based on supply and demand dynamics or projected interest rate changes on commercial real estate loans. And because we've seen such sharp spikes in interest rates over the last year, this has resulted in significant cap rate expansion in a very short period of time, and has also led investors to speculate on when interest rates will start to come back down again and when we'll start to see some sort of cap rate compression related to those drops. And speaking of changes to cap rates in relation to interest rates, the next term that I want to cover in this video is the risk premium assigned to an investment and how this applies to both equity and debt investors. The risk premium of an investment refers to the incremental return over the assumed risk-free rate in the market that an investor is going to require to justify the risk associated with making an investment in the first place, with the risk-free rate of return referring to the yield on an investment vehicle where there's very little or no perceived default risk and virtually 100% certainty that the investor is going to receive all of their capital back plus any interest payments owed on time and in full. In the US, the risk-free rate used as a benchmark for both debt and equity investors is usually going to be the equivalent term US Treasury yield, essentially meaning that if an investor is looking to buy and hold a commercial property for 5 years and is willing to accept the risk and the work associated with making that investment, that investor is also going to want to make sure that the return they can expect to generate is going to be far in excess of what they could otherwise earn just by buying 5-year treasuries. And this applies to equity investment analysis, but this also applies to how lenders price out commercial real estate loans, and this is directly related to the next two terms on this list, and these are the widening and tightening of lending spreads. Similar to the risk premium that equity investors will use to value commercial properties, lenders also price in a risk premium on commercial real estate loans, and this risk premium is generally referred to as the spread on the debt, which is again going to be added to that assumed risk-free rate in the market. And to illustrate this with a debt side example, if a lender is considering making a 7-year commercial real estate loan, that risk-free rate, which is commonly referred to as the index rate for the lender, is also usually going to be the 7-year US Treasury yield, but the lender is also going to add a spread over that index rate figure to make sure they're being compensated for the risk associated with lending on a commercial real estate asset. And with interest rate volatility being one of the biggest risks to lenders, especially those lending in a rising interest rate environment like we're seeing today, volatility in the credit markets can create significant upward pressure on lending spreads in commercial real estate, which is also something we've seen over the last 12 to 18 months. And when lending spreads increase, this is referred to as spreads widening or going out, which can be common when there's a significant amount of uncertainty in the market. And when lending spreads decrease, this is referred to as spreads tightening or coming in, which tends to happen most in healthy market conditions with a significant amount of competition between lenders in the market. The bottom line here is that if you hear someone talking about spreads coming in or spreads going out, this is referring to that risk premium changing on the lending side of the equation, and widening spreads indicate that risk premium is increasing, while tightening spreads indicate that risk premium is decreasing. Ultimately, all of these topics are very top of mind right now for commercial real estate investors and investment firms, and if you're still relatively new to the industry or your goal is to break into commercial real estate in 2023 or 2024, I hope these explanations are helpful in getting up to speed with all of the industry jargon that tends to be used in this industry. And if you are in the process of the job search right now and you want to make sure you have the skills you'll need to land a role in commercial real estate or pass an Excel modeling exam that might be given to you during the interview process, as always, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on commercial real estate terminology that might not come out of a textbook, make sure to hit the like button and let me know. And let me know in the comments any other terms or concepts you'd like to see covered in more detail in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.